Hello, everyone. Welcome to the webinar today. My name is Alexandra Alvarado, and I am AAOA's Director of Marketing and Education. Welcome back. I see some familiar names coming through in our participants today. As you're coming through, if you'd like to give us a hello in the chat, tell us where you're coming in from, that would be great. Just real briefly, I want to give us a quick introduction here. Our topic today is DSTs and UPREITs. Which is the better option? You may have heard of both or maybe neither, but they're both great tools. It just depends on what your needs are. And we're going to go over the pros and cons of each, how they work. And of course, we have with us our expert, our resident expert here, Rick Gann. Rick has been doing webinars for us, I think, for like about the last 4 years or so on various topics. And he is a excellent resource for everything to do with DSTs, 1031 exchanges. And in general, he has a background in law. He also has a background with real estate and helping real estate professionals. Primarily, I'll give you a little bit more information about Rick here on the call. He's been a member of the state bar since 1997. And while he was finishing law school and studying for the bar exam, he befriended his then neighbor, Jason McMurtry. And now they've been working together without interruption, with a few interruptions for over 20 years. And they essentially lead 1031 capital solutions. They've developed really quite a robust educational platform and resources for their clients. In the past, before this, Rick practiced law. He also was a licensed real estate broker. So many different angles here of expertise coming from Rick. So it's always great to have him as our expert that you can ask questions to. We're going to go through this webinar. It likely in under an hour. We'll have time for questions at the end. So please put your questions in that question box, not the chat. So if you see down below, you'll see there is a Q&A box, or it might be above, depending on your setup. And there's also chat. So just be sure to put the questions in the Q&A. I'm going to be looking there first for all of the questions, and throw them in there whenever you have a question pop up in your head. Tomorrow, we will be sending everyone the recording as well. So keep an eye out for that. You'll get that along with Rick's contact information, so you can review it and the slides as well. So keep an eye out. Tomorrow, by the end of the day, we'll be sending that over to you. So feel free to share it with anyone you'd like. With all that said, Rick, thank you again for coming back to talk to our group. So excited to hear this presentation. It's a slightly different take than what I've seen you present on before. So looking forward to learning more.
Thank you so much, Alexandra. I really appreciate every time you give us the opportunity to present to members of AAOA. And like you said, today we are going to touch on our two primary options for investing in a passive replacement program: conventional DSTs and UPREITs, or more specifically, what I call pre-REIT properties. And the question on the screen asks, which is the better option? Well, I'm going to give you the answer now. The answer is both. And I say that because it really does depend on your individual circumstances. More than half our slides today apply to both strategies, so we'll start by setting the stage for all passive replacement programs, and then we'll pivot into the differences between 1031 exchanging into conventional DSTs versus 1031 exchanging into pre-REIT properties. Now, before we get started, I am required to make a few disclosures. This presentation is not a solicitation. There are material risks in investing in DSTs and REITs, including loss of principal. No secondary market exists for DSTs. The fees and expenses associated with packaged real estate securities programs are typically higher than traditional real estate. These programs are sold as private placements and therefore are only available as accredited investors. And despite our name being 1031 Capital Solutions, we do not give, and this presentation does not constitute tax or legal advice. Okay, a little bit more about us, and thank you for that kind introduction. But our branch offices are in our network are in San Diego, where my partner Jason McMurtry is. We're also in Sacramento and in Colorado and in Seattle, where I spend most of my year. In addition, we have folks working remotely in Portland, Los Angeles, and Denver. I encourage everyone to visit our website, 1031capitalsolutions.com, where we have copious articles, blogs, videos, and educational content. In a nutshell, we are a financial services firm that exists for the purpose of helping individual property owners retire from being landlords. And on that note, in 2020, we published a book on this very topic, which is available in both print and electronic formats on Amazon. However, if you go onto our homepage, you can easily find a link where you can order a free hard copy of the book delivered right to your door. Please know that we intend to provide time for Q&A, but if somehow we don't adequately address a subject or answer your question, you are welcome to schedule a call on our website. All right, so I was just wrapping up, reminding people about us and our resources. Thank you again for your patience. Sorry about the glitch. And again, please visit our website, 1031capitalsolutions.com, to access our resources and order the book. And with that, let's get into it. So let's talk about the applicability of the topics in today's webinar. The most common client scenario we see is an individual owner of a rental property who, for any number of personal, financial, or regulatory reasons, wants to sell a property and reinvest 100% of their net sales proceeds into a portfolio of passive replacement programs. The factors driving landlords to sell their rental properties, particularly owners of residential rentals and members of AOA, include increasing legal liability, screening regulations, security deposit restrictions, annual caps on rents, eviction procedures, just cause tenant removal restrictions, negative demographic trends, increased state and local taxation, other macroeconomic factors, maintenance hassles, mold abatement, and looming capital expenditures like an upcoming roof replacement, for example. Again, for most of our clients, and likely most of you on this webinar, whatever they are selling is probably the last rental property that they ever want to self-operate. Based on these motives, our clients in this category will reinvest their entire proceeds into passive replacement programs. However, from a purely financial perspective, arguably the most compelling reason to replace a single rental property is the fact that your equity over time has increased more than your annual rental revenue. This is a common phenomenon in California and in the Seattle market, particularly with respect to single-family residential rental properties that are worth more to a future owner-occupier than an investor. People who own highly appreciated houses, townhomes, and condos are effectively able to arbitrage the difference in value between their property as a rental and its value as another buyer's home. Combined with the mathematical impact of paying down debt over time, our clients typically are sitting on rental properties whose net yield as a percentage of their current equity is less than 3%. In other words, if you are in this category, you are no longer receiving a yield that is commensurate with the hassle and liability of owning rental housing property, particularly in California, Oregon, and Washington. And unfortunately, due to the long-term trends of negative domestic migration, job losses, skyrocketing insurance costs, and increasing tax burdens, many markets on the West Coast are no longer a safe bet for continued appreciation. Obviously, we don't have a crystal ball, but I can say with total confidence that the real estate market on the West Coast for the next 20 years is not going to look like the last 20 years. The second most common scenario that we see is a 1031 exchanger who already has a primary replacement property lined up, but the dollar amount for that replacement property is not adequate to replace the entire value of the relinquished property. And in this example, the net sale price of the down leg was $8 million, but the client's best option for an up leg property is only $7.37 million. DSTs can be a great option for filling what I call the stub amount here, because there is no fixed or incremental investment requirement above the typical $100,000 minimum. So for this and other reasons, DSTs have become an increasingly popular way for larger investors to complete their 1031 exchanges without triggering what we call taxable boot. As most of you probably know, in a 1031 exchange, it's okay to fall short of replacing your full down leg value, but at some point, incurring too much taxable boot will defeat the purpose of doing a 1031 exchange in the first place. And this is because under federal tax rules, all funds received in a 1031 exchange are treated first as recognized gain. If you receive all your gain in a 1031 exchange, you end up with the same tax consequence as doing no exchange at all. The solution, of course, is to conduct a tax-deferred exchange under Section 1031 of the Internal Revenue Code. This webinar assumes some basic understanding of 1031 exchanges, but as a reminder, a basic caveat of achieving complete tax deferral is the requirement that a taxpayer replace the entire value of their down leg property. Down leg is just another way of saying the property that you sold. For 1031 exchange purposes, the replacement value is not the full sale price, but rather the sale price minus commissions and other customary transactional expenses. Even if you paid off a loan in a 1031 sale, you still have to purchase a property of equal or greater value. In other words, to defer all taxes in an exchange, you must replace all your equity and all your debt. As we'll see in a few minutes, a 1031 DST provides an opportunity to replace your existing debt without being a direct party to a new loan, which is a considerable benefit for folks who are either unwilling or unable to go through the process of obtaining a new loan. As a reminder, in a 1031 exchange, you must identify your potential replacement properties within 45 days of close and complete your purchase within 180 days. There are no exceptions to these deadlines unless the federal government issues a regional extension relating to a natural disaster, or as we saw for the first time a few years ago, a national deadline extension due to a pandemic. In the case of 1031 DSTs, we rarely worry about either the 45-day or 180-day deadlines because DST investors usually complete their exchange within the first 2 weeks after close. Now that we've set the stage for a 1031 DST investment, let's delve into the key aspects of the strategy. The primary purposes for investing in a 1031 passive replacement are, first and foremost, tax deferral that becomes tax avoidance upon death. Most people doing a 1031 exchange are not merely hoping to kick the tax can down the road a few years. The idea is to avoid paying the capital gains tax altogether by combining the 1031 exchange benefit with what's known as a step up in cost basis. Under federal law, the taxable cost basis of your real estate investment is, quote, stepped up to its fair market value as of the date of your death. which allows your heirs to sell that investment without paying all the capital gains tax you deferred over the course of your life. Okay, other purposes for investing in a 1031 passive replacement are updating to a fractional interest in truly passive, institutionally operated property. If applicable, benefiting from prearranged non-recourse financing, flexible timing and investment amounts, a focus on income and capital preservation, and an automated closing process with no escrow or notary. The structure of the initial 1031 investment is a fractional ownership in one or more properties held directly by a Delaware Statutory Trust. In other words, when you invest in a DST, economically and for tax purposes, you are a fractional owner of the real estate held in the trust, but without the legal liability, because the legal title to the property is held by a trust formed in the state of Delaware. The investment is qualified as like-kind replacement property under Internal Revenue Code Section 1031 per IRS Revenue Ruling 2004-86. We are now 21 years into the growth of the 1031 DST industry. The typical attributes of a 1031 DST program include a master lease portfolio of $25 to $500 million of real estate, usually with 10-year financing and a 5 to 10-year interest-only period, subject to an average hold of 5 to 7 years, during which, of course, the investment is illiquid. There are basically 4 possible exit scenarios after investing in a 1031 DST. You can cash out and recognize taxable gain at that time. You can 1031 exchange back into conventional real estate. You can 1031 exchange into another DST, or convert to operating partnership units of a REIT under Internal Revenue Code Section 721, which we'll discuss here further in a few minutes. The difference between these exit scenarios is really what defines the difference between a conventional DST and a pre-REIT property. And as a reminder, for your heirs who ultimately will receive your passive replacement property, they inherit stepped-up property with no or nominal taxable gain, and they can potentially redeem inherited REIT units relatively quickly. I touched on this earlier, but it's important to understand how unique the debt structure is in these programs compared especially to traditional real estate financing. Again, these properties have non-recourse financing already in place between the trust and the lender before the first investor subscribes to the offering. So for you, the investor, there's no loan qualification, no application, the bank doesn't know who you are, there's no personal liability, no loan payment responsibilities, no notarized closing docs, no public record tying you to the loan, and no longer an item on your credit report. And yet, you are able to replace your existing debt for 1031 exchange purposes. The typical DST loan terms are 30 to 55% loan to value, meaning the loan is typically between 30 and 55% of the value of the property. On a 10-year term basis, usually a fixed rate, but if it's not fixed, the variable rate will be capped, which effectively makes the interest rate fixed. But most of the programs have a fixed interest rate. These deals will have an interest-only period between 5 to 10 years, usually with a 30-year amortization schedule after the interest-only period. Sometimes these loans are assumable. Sweep and reserve conditions often apply, and almost always there's a prepayment penalty on these loans. Okay, let's finally get to the heart of the matter, which is the difference between the conventional DSTs and what I call pre-REIT properties. Now, for the first 10 years of 1031 DSTs, they all had the same outcome. The sponsor, uh, which is what we call the big real estate companies that put these deals together, the sponsor would sell the property on behalf of the DST investors, usually after 6 to 8 years, and the investors could either cash out, 1031 exchange back in traditional real estate, or 1031 exchange into another DST, which is what the vast majority of people do. Essentially, in a conventional DST, when the DST property is sold 6 to 8 years from now, your exit options are no different than what you have today on your existing rental property. Then, starting a few years ago, we began to see more and more DSTs structured as pre-REIT programs in which a large real estate investment trust selects a property from its existing portfolio, repackages it as a DST, raises capital, holds that DST property for 2 years, and then repurchases that same property back into the REIT under what's called a 721 exchange. Again, under Internal Revenue Code Section 721, the owner of a property, in this case a DST property, can contribute the property to a REIT partnership in exchange for REIT partnership units without recognizing any gain. And today, half of all DST dollars are being invested in these pre-REIT offerings. The technical term for REITs that can utilize Section 721 is Umbrella Partnership Real Estate Investment Trust, or UPREIT. But because virtually all syndicated REITs are structured as UPREITs, we usually drop the up and just call them REITs. Now, most of these programs are non-traded REITs that operate analogous to a mutual fund, meaning the REIT sells and redeems interests directly to and from investors rather than listing shares on a stock exchange. After you're in the REIT for 12 months, subject to the overall limits of the redemption program, you may request a redemption for any dollar amount up to the full amount of your investment value. Now, of course, liquidating interests in a REIT partnership is a taxable event, and such interests cannot be further exchanged on a tax-deferred basis. So under the pre-REIT strategy, investors do lose the ability to conduct future 1031 exchanges, but ultimately end up in a more diverse portfolio that is slightly more estate-friendly than a conventional DST. I should note, however, that REIT investors receive K1s and the tax reporting, may be a little bit more involved than a typical DST. From a purely investment-based point of view, the key difference with the pre-REIT strategy is that you are only investing in the initial 1031 replacement property for a couple of years, and then ultimately your equity rolls into the REIT. And unless you cash out and pay the taxes, you literally spend the rest of your life invested in this multi-billion-dollar portfolio of institutional real estate assets. In the conventional DST strategy, you are always invested in one or maybe a small handful of properties with the opportunity to exchange out of that DST portfolio every 6 to 8 years on average. So given these two options, why would anyone choose one versus the other? Well, let's review the decision factors for both conventional DSTs and pre-REIT properties. With conventional DSTs, you are far more likely to have built-in financing. Most of the pre-REIT properties do not come with built-in financing, whereas most of the conventional DSTs do. So if you need to replace debt as part of your 1031 exchange because you paid off a loan on the property that you just sold, you are more likely to want to go into a conventional DST because there is more likely to be a financing option with the available conventional DST programs than with the pre-REIT programs. So debt replacement is a key factor. Also, you might want to do a stub investment into a conventional DST that allows you to exchange back out into traditional real estate because you may not be interested in having a chunk of your 1031 portfolio be pre-slated to go into a REIT asset. In other words, our clients who use the DSTs as a stub amount to fill an exchange are usually clients who intend ultimately to stay in the conventional real estate world, owning traditional real estate assets, and are really looking at the DST as a temporary 1031 option that allows them to redeploy that equity back into traditional real estate later on. So the stub investment scenario lends itself towards the conventional DSTs a little bit better. Also, some of our younger clients in particular simply aren't ready to let go of the optionality to be able to 1031 exchange back into traditional rental properties. And if it's really important to you today to be able 6, 7, 8 years from now to take that equity that you put into a DST and go back to owning your own rental property, then you are far more likely to look at a conventional DST than a pre-REIT property where you're never going to have that 1031 exchange option again. And then finally, the traditional DSTs do have that Schedule E simplicity. You literally use the same attachment on your tax returns to report your net income and depreciation from a DST as you do on a traditional real estate. So you or your tax accountant, are using the same form you've been using for your rental property to report your DSTs. People like that simplicity and familiarity. Now, on the other side of the column, pre-REIT properties, the decision factors there are someone who is happy to forego the optionality of a future 1031 exchange. In other words, you actually would prefer not to ever have to do another 1031 exchange. And so going into the pre-REIT strategy basically allows you to only do a 1031 exchange one time and then set it and forget it and never have to worry about that process again. Obviously, that is a draw for the pre-REIT option. Pre-REIT properties also give far more diversification opportunity than you can get through a series of DSTs, even though we do have DSTs that might even have a dozen properties in the DST. When you compare that to hundreds or several hundred properties in a REIT, the diversification is really attractive in going down the REIT route. You also have greater income certainty if you 1031 exchange into a pre-REIT property, or maybe 2 or 3 pre-REIT properties, where ultimately your portfolio is invested across 1 or 2 or 3 large REITs. Historically, the distribution certainty of multi-billion-dollar REITs is higher than you can achieve from any portfolio of conventional DST properties. So you really do benefit from the sort of the conservative income focus of a REIT or more than one REITs in your portfolio. And then finally, the redemption opportunity. Again, it defeats your tax strategy to redeem shares from a REIT during your lifetime. But people like having that, at least knowing that if they wanted to get at that money, unlike a rental property or a conventional DST, with a REIT, you could invest $1 million in a REIT and call me up 5 years from now and say, hey, Rick, we've decided we want to get a boat and we want to take $200,000 out of our REIT investment, and we fill out a form and they send you a check. You're going to get taxed on that. So you want to make sure, that boat is a $125,000 boat, because the other 75,000 you're going to spend on taxes. But you have an ability to access that principal in a way that you don't have with any other 1031 qualified investment option. But more importantly than your ability to access the funds during your life, in my opinion, is the ease of inheriting a REIT investment and the ability of your heirs, if they so desire, to liquidate that REIT asset at their discretion quickly and easily, rather than inheriting a rental property or even a DST, which is, of course, passive. But if you inherit a DST interest, you have to wait for that property to be sold to receive your share of the principal, whereas in a REIT, you have the potential to cash out within a matter of days. So again, is one better or worse? No. They're just different, and whether a conventional DST or pre-REIT property is better for you depends entirely on your individual circumstances. Finally, it's important to touch on key considerations like limitations, fees, and risks. In a typical DST structure, the sponsor buys a property, packages it up as a DST, and resells that property a few weeks later with a marked up price. Resell it meaning now selling that property in the form of a DST to 1031 investors. Under state and federal securities rules, the sponsor is required to provide a detailed description of the full use of investor proceeds, including the original purchase and all categories of that marked up price. The four major categories of a DST markup are reserves, syndication costs, sponsor fees, and transaction expenses. In a conventional DST, because a real estate sponsor earns most of their profit over the life of the DST from the acquisition fee, the markup tends to be higher than in a pre-REIT property, in which the sponsor will receive annual management fees potentially for decades. When you invest in a DST, the entire balance of your bank account at the qualified intermediary is wired to the DST, and that entire amount divided by the equity offering of the DST determines your ownership interest in the property. But understand that you are indirectly paying for the markup expenses because they are already built into the price of the offering. So before we take questions, I will close by repeating some of the most important considerations when investing in a DST. General real estate risks still apply. There are no guarantees. A client's income and principal are at risk, just as with any real estate investment. 5 to 10 years is the typical hold period for a conventional DST, with 6 to 8 being the historic average. DSTs are illiquid until the property is sold or until 12 months after a 721 UPREIT conversion. Investors must be accredited and meet general suitability requirements. We typically rely on the net worth test under SEC regulations, which requires an investor to have a net worth of at least $1 million, excluding their home. 1031 investments require strict compliance with forms and deadlines. And as we just discussed, program fees and expenses, of course, are higher than conventional real estate. So at this point, Alexandra, we can take questions if we have any.
Yeah, absolutely. I'm going to launch a poll question as well. If you would like to schedule a complimentary consultation to find out how you can exchange your rental property for a better lifestyle, Rick is, as you all can see, quite the expert in this, so he'd be able to give you a really fair assessment. I think One of the things I really like about what you all do is you really look at the individual situation and see what actually makes sense. And you're not afraid to say that, hey, maybe a conventional sell might be better. But if there is something better for you, like a DST or UPREIT, then, you'll also be able to kind of compare and see what those benefits might be. So highly recommend taking advantage of that. If you say yes to this poll question, I'll share your information with Rick after the webinar here. So let's dive into questions. We do have a question from Andrew. He asks, isn't there a maximum stepped up basis?
Is there a maximum? Well, so the concept of the stepped up basis is that you bought a property, say 30 years ago, and that property has in real terms, in dollar terms, in market terms, has appreciated probably maybe tripled in value. But your actual taxable cost basis for purposes of determining what your capital gains tax would be has in all likelihood gone down, notwithstanding that any capital expenditures that you may have made on the property, which does increase your cost basis. But if you set aside any improvements that you made to that property, you're starting with your purchase price of that property as your initial cost basis, and then the basis is going down. Why is the cost basis going down while the value is going up? It's because you've been claiming depreciation deductions every year over the ownership period of that property. And if you own a residential rental, as most of you know, you can depreciate a residential rental property for 27 and a half years. And the depreciation is based on the value of that land minus the land. And so if half of the value of your purchase price originally was the improvements on your land, and then you depreciated all of that down, then your cost basis today on your real estate was basically the land value of your property when you bought it 20, 30 years ago. So there's this huge difference between your cost basis and the fair market value of the property. And if you sold that property the day before you died and you didn't do a 1031 exchange, you would pay capital gains tax on the difference between that reduced cost basis and the sale price or the net sale price. Mm. When you pass away, the cost basis steps up. That's why the term comes from, because it's down here and it's stepping up to the fair market value of your property. And so you're right, the maximum step up in basis is what is the fair market value of your property. Now, there have been proposals, and during the Biden administration on the White House website, one of their proposals was to cap that step up basis benefit to $1 million. And so if that's what you're thinking of, there were proposals out there, one from a senator in Maryland in particular, who feels that the step up in basis is a loophole. And of course, what I always say is any tax benefit that requires you to die is not a loophole. But today, under tax law that is decades old, your step up is in cost basis is the fair market value of your property.
Yes, happy to see that's still something that we don't have to worry about, at least for a little while, going away. That things could always change. We'll see. Roy Fishman asking, I have heard that many REITs have a limitation on withdrawing and they'll penalize withdrawals.
Well, yeah, and that's why I say subject to the redemption limits. The devil's in the details. Most of the programs that we offer, the total amount that the REIT could redeem in a year is 20% of the value of the REIT. So in a simple example, if a REIT has a $5 billion portfolio in terms of the net asset value, then that means that they could not redeem more than $1 billion worth of redemption requests in a given year. And more specifically, what they typically do is cap the redemptions at 5% per quarter. And so if if a REIT hit the 5% limit every quarter, they would hit the 20% annual limit by the end of the year, which makes sense because how could a REIT redeem all requests? Where would that money come from?
Yeah.
So these big multi-billion-dollar REITs keep enough, have enough liquidity and enough of a capital raise flow so that they could honor 5% quarterly redemption requests. And one of the things we look at in our due diligence is what has been the recent and current redemption request history so that we can gauge whether a REIT is having any issues honoring its redemption requests. And of course, the programs that we use do not have that program because they are multi-billion-dollar institutional funds where the vast majority of people are investing on a very long time frame. But your question is right on, and the ability to redeem shares is not limitless.
Yes, good point. Ken saying here, can you go straight from rental to UPREIT, or do you have to go to DST first before UPREIT?
It's funny that Alexandra and I had this same question come up from an AOA member this week.
Mm-hmm.
So, by the way, Section 721 was designed originally years ago so that someone could contribute a property to a partnership in exchange for partnership interest without having that transaction be a taxable event. And so what the 1031 DST / UPREIT industry has done is taken that concept and just expanded it to a much larger scale so that the property that's being contributed to the REIT is a $100 million DST property instead of a $500,000 rental property. But it's the same concept. So if you own a property that would fit the investment strategy of a real estate investment trust, you could in fact basically exchange your property directly to that REIT in exchange for REIT shares. And so that is entirely a theoretical possibility. And at the institutional level, I happen to know one investor in particular, a wealthy gentleman who contributed tens of millions of dollars of institutional caliber real estate to a traded REIT in exchange for REIT shares. So it can be done. Just keep in mind that you need to own a property that fits within the investment criteria of that REIT. And most of the REITs own institutional type real estate where the average property value is tens of millions of dollars. And so I don't want to discourage you from pursuing that. It's just you got what type of REIT wants the type of property that you own. If you can find a REIT that invests in your type of property, then absolutely you could skip the DST process and do a direct exchange.
Yeah, and Elizabeth had a similar question as well, which was, what is a public REIT, and can a REIT sell your portfolio to a public REIT?
So there are a few categories of real estate investment trusts with regard to how they're categorized under securities laws. And so many of you are familiar, maybe even in your own investment portfolios, with public traded REITs, meaning a REIT that is listed on the New York Stock Exchange, for example, that is a public company and also lists its shares. And you don't buy your shares from the REIT, you buy your shares from someone else who owns shares of the REIT. That's the largest category in terms of market capitalization. Then you've got a significant category, billions of dollars in REITs that are public companies, but their shares are not listed on a stock exchange, much like a mutual fund. A mutual fund is typically a public company, but the shares are sold and redeemed directly by the fund. And that's a loose analogy. I'm not trying to compare REITs to mutual funds, but in terms of how you own your interests, it's a good analogy. And so that's a public non-traded REIT. And then there are private non-traded REITs where some of which are also multi-billion dollars, where they have decided to forego the costs and expense of public registration and all the state filings that come with that. And so it's a private offering available only to accredited investors. And so you just like the public non-traded, it's a non-traded REIT. You buy and sell your shares directly to the REIT, uh, but it is not publicly registered. So those are the three categories, and most of the programs that have these 1031 programs are either public non-traded or private non-traded REITs.
Okay, good to know. Viraj is asking here, does the step up work for real estate held under LLCs?
Yes, because your LLCs, for tax purposes, passes through to you. And so really what it is it's your interest in the LLC gets a step up. But yeah, the fact that you own your rental property in an LLC does not affect the ultimate tax consequence of being able to get the step up in basis, because the value of the property really is the value of your LLC interest. And because that's a pass-through entity for tax purposes, the step up in basis passes through to you as well.
Well, that's good news. I'm sure most of the attendees here have an LLC. So that concludes our questions, I believe. I haven't seen any more pop up here. Thank you for going through all of that, Rick. We're going to send everyone the recording tomorrow, as usual, with Rick's contact information. When you registered, we did have a registration question asking you if you wanted Rick's book, either a hard copy or emailed digital version. So we'll let Rick know who requested what so we can get you over your free book if you wanted that. And also, if you said you wanted a consult, I'll be sharing that with Rick after this webinar so you all can connect. And thank you again, Rick, for going through all of this and providing a lot of clarity, I think, where there is so much confusion. I hear so many things from people, and they always tend to think that it's something a little different, or there are some, I think, common myths floating around there. I'm sure you've heard them all by now. So it's nice to have a bit of clarity on a webinar like this.
Well, and even on a webinar like this,
Mm-hmm.
to get that clarity, you really have to be focusing, and I understand most people have this webinar up and are multitasking. So sometimes it
Mm-hmm.
takes two or three of these for it to sink in. But another way to cut past that is just schedule a call with us,
Yeah.
and we'll walk it through directly. And lastly, Alexander, as a free service to AOA members, we are happy to conduct a cash flow analysis on your
Oh,
rental
yes.
property. That's a complimentary service. We don't charge for that. And like you mentioned early on, Alexander, sometimes the result of that is a recommendation that you hold on to that rental property because it is performing really well relative to your equity, and there's really no compelling reason to sell it. That's about 1 out of 50 times, but sometimes that is the result. And I will tell you if I feel that way. Most of the time, though, especially folks who own, like I said, homes, townhomes, condos, your equity has increased so much relative to your income that it just doesn't make sense, as a percentage of your equity to keep holding on to that property. And we probably have better options for you. But happy to conduct that analysis for anyone on this call.
Amazing. Well, I hope you all will take advantage of that as well. And of course, we'll be in touch with an invite for next week's webinar as well, which is how to create a website for under $20 under 24 hours. So if you all have a website you hate, or you have one, or you don't have one at all, it's not that hard to get started. And I think, it's probably beneficial for almost everyone on the call today to have one. So check out the invite for that webinar in exactly 1 week. And we'll probably have Rick come back soon. We're looking at schedules. I was actually talking to Rick about that already. He's going to be having some really interesting topics coming up in the following year. So keep an eye out. Thank you all for coming and for staying on the call. We enjoyed having you and hope you all have a wonderful day too. Take care.
Thank you.
Bye.